Hello again, everyone, and welcome to lesson 9 or chapter 9 of Learning to Day Trade with Tony. This chapter is about level 2 and hotkeys. We'll talk about dark pools and routing and various other things as well, but just going to talk about level 2 and hotkeys. In my opinion, reading level 2 is really important for day trading. I wouldn't say essential. I know there are some traders that don't really rely on level 2. They just focus on the charts, and that's okay. That's okay. Um, you can be profitable just focusing on the charts and not really bothering with level 2. It is possible, but I think if you can get a good understanding of level 2, it can really help you. Okay, being able to read level 2 can be beneficial in the long term and help you be successful as a trader. One of the things that you'll see me doing a lot are quick trades. Some traders might call it scalping, or where you take small profits, whether it's 10 cents, 20 cents, 30 cents. It's relatively small profits. These are small percentage gains, okay? Just these are small percentage gains, and they're usually, you know, just a few cents, 5, 10 cents, and this can be a consistent way of building profit throughout the course of the day. Over the course of weeks and months, those profits add up. So for me, it's a strategy that I will use in certain markets and for certain patterns. Okay, so for example, news plays and IPOs and stuff like that. Without level 2, it becomes difficult. I would find that difficult to do. Okay, so understanding level 2, if you're gonna be a scalper, if you're gonna do things like that, I think level 2 can really help you in the long term. Okay. Now, what I would just going to go over here is I'm just going to talk you through the various areas on the montage, and then we can actually get into some of the details and around what is important for level 2. So right here, you've got what the last sale is. This is level 1. So it's essentially level 1 here is the bid and the ask of the price at any given time. Now here you've got the VWAP. Now you can change this. I like to change this to LDLU. So it's limit down and limit up. And what this gives me, it gives me the halt levels that are coming. If a stock is looking particularly volatile, and you actually change what the VWAP's saying here to this is volume weighted average price, by the way, for those that are not in, and you change that to level down, level up. There's a number of different things you can change this to, but I change it down to level down, level up because I have the VWAP on my chart as a technical indicator. And if I'm looking at the level down, level up, it allows me to see where the halts are going to take place and where the either up or down, and that gives a good indication. If we're getting a volatility halt, you can very often get into a position and they will gap up a lot of the time, depending on the volume of the halt up and you know that's where I got my big trade a couple of weeks ago. I got in on a stock just prior to a halt up, and I was able to take big size. And when it gapped up for three whole dollars. Which is 25% of the price hike, and I made $67,000 on that particular thing, and that's by knowing where the halts are. It's really good. Okay, so now here you have the actual level 2 itself, and this gives you the orders. It shows you the orders that are in place at the price points. It's color coded, so we've got the bid and the ask. And so it's basically telling you what the sell orders are, and what the the buy orders are. So the bid is what people are bidding to buy, and ask is what people are looking to sell at. Okay, so you can actually get in on the ask, and you can get out on the bid. But and that's what I tend to try to do. I've got my orders set up, and I'll go over it with regards to my hotkeys and my hot buttons. I've got my orders to actually buy on the bid and sell on the ask with some slippage, so that way I'm getting the best possible fill. And if there are people looking to buy outside of the bid and the ask or market price, then you can very often get a better fill that way. Here we have the time and sales, so often referred to as the tape or the ticker. And what this gives you is what the last price was, the quantity and the time that it happened, and where it actually took place, which exchange it actually took place. Okay, so that's the time and the sales. On the montage, you've got the volume button here. And you've got the spread as well. So you can get a lot from you can get a lot from the level two. So just moving on to the next one, I want to talk about getting support. What you're looking for from the level two. What you're looking to get from the level two. Is you're getting support from orders that are already in place, so you get to see where the orders actually are. Okay, so what I like to do is when we're talking about the bid and the ask support. So it's support and resistance. I like to buy when I see a large ask getting bought up in the level two, but by a ton of volume. So if I see an order sitting there on the ask, that tells me that this level of resistance, let's say it's 3.45, $3.45 just for it, or $3.50, is being respected, and there are traders sitting there holding it down a little bit. Okay, but eventually, if there are enough buyers, we'll buy through everyone's order that's sitting there on the offer, and then we'll get that quick pop. Okay, anyone that's short is going to cover, and we get a quick pop. And in that case, it might only be 5 cents or something like that. It might not be a huge pop, but in the case of a big stock that's maybe $35, a pop like that could be 40 or 50 cents. Okay, so it's not uncommon to see very quick pops, and those are opportunities to make quick profits. So scalping off the level two, if you will. So you can get a quick trade, a quick pop, and we're talking like a minute or 2 minutes, just a couple of minutes, and you make $140, $150 just off a quick scalp. Okay, so you get that, you book it, close it. You're not looking to stay in it. You just get it, quick profits, move on to the next one. That's what a lot of scalpers will be doing. Okay, so when I see someone there on the ask, I know that there's a level of resistance in play. Okay, now I may not. If that level of resistance doesn't correlate with something that I see on the chart, then I'm not really going to care about it. But when it's at a level like the $half-dollar level, so $3.50, for example, that $half-dollar or a $3 whole dollar level, um, you know, if it's right at the high of day, if it's something like that where we see that there's resistance that's lining up, and we can see it on the level two, on the bid and the ask correlate with the chart. For me, that's much more significant, right? When you do get that pop over a level, you can get shorts decide to cover. People that are sitting on the sidelines, like me, like a lot of people that are watching the action, they want to jump in, and you get that big surge of volume. So a lot of the time, the charts we look at, the charts that we're looking at that say there's a potential breakout, what we want to see is a stock that's typically in consolidation. Maybe there's a flag, a bull flag, or a flat top breakout, ascending wedge, etc. And then all of a sudden you get that quick pop. And there are stocks that we've traded that are a little bit higher price. That when they make that pop, you know, let's say it's a higher price one, 350, $100 stock, for example. It pops up from 110 to $112 and then runs, another point. Okay, so we can have stocks that break out at that critical level of resistance and go for you a point or two or 3 points. And for us, that gives us a tremendous amount of profit potential. And we're only in the trade for a short period of time. So our risk based on exposure time is limited. So this is the same for a stock that I might be looking at shorting as well. If I see a stock sitting at $3 and I'm thinking, when this thing breaks $3, it's just going to flush down to 280. Anyone that's long is going to bail out, and that's where the shorts they get in there, right? They're going to take advantage of the weakness of the longs because realistically, if you're in a trade to the long side, let's say you got in at 320, you want to see it up at 350 or whatever, and it's down hovering around $3. By the time it breaks $3, the likelihood is, you know, sitting at $3, 3 or 1 or 3 or 2 is a major sign of weakness. It's an indication that we should be getting out as getting out of the trade as soon as we can. Okay, it's just not going to play out the way we wanted it. So if you're still holding down 20, 30 cents, and you're kind of asking for trouble. Okay. If it breaks that $3, it's a psychological resistance level, psychological support level. These levels are important, as I keep saying, the whole dollar levels. It breaks that, the shorts are just going to pile in, and you'll get that quick flush to the downside. It's a combination of the shorts getting in, so they're selling, and the people that are long that are maybe newbies or just for whatever reason got emotional and held too long, and they decide to market order out and they get a horrible fill down at uh, 290 or 285 or whatever it might be. Okay, and it just causes that quick panic, that quick washout. So learning to anticipate where we're going to have those quick washouts or quick spikes to the upside, we can get in just before they happen and realize some pretty significant profits. It's kind of like using level two in connection with the strategies that we all already are trading. So the momentum strategy, when we see a strong stock and it pulls back and then it gets ready for that second leg up. So that pullback, if it topped out at a critical level of resistance, say, and it's, let's say, $39 even, right? And that whole dollar pulls back to 38.50, and then when it breaks through that 39, that whole dollar, a lot of times you see that quick squeeze. Okay, so just by knowing what to possibly expect on the level two can help us size accordingly. So when we're looking at trades, we can think, well, I'm going to take a little size here at 38.80 with the intention of doubling up at 39 if it breaks, and we get that squeeze, right? If it breaks by 2 pennies and then pulls back, then we get out quickly. That's something that I look to do most of the time. Okay, there's no reason to hold when something pulls back like that because it's just it's not only retesting the resistance line that it broke, it's actually breaking it. I don't mind it pulling back to the resistance, tapping it, and looking at it for a support level. But when it breaks it, it's that's kind of a sign of weakness. Okay. So now the timing sales window. The timing sales window, or the tape, or the ticker, or whatever you want to call it. The timing sales window. What we're looking at here is where we see the actual orders actually passing through. So this is a bit of a lagging indicator. So the level two is showing you what's potentially the orders waiting to be fulfilled at certain levels. The time in sales is a lagging indicator. It's actually telling you what orders have just transpassed as in real time. Okay, so every single order passes through on the time and sales, and it's going to be usually either a red font or green font. Now remember, anytime a transaction is placed on the market, um, the market is it's a zero sum market. So what that means is that anytime you're selling, someone else is buying from you. And anytime I'm buying, someone else is selling to me. So the number of shares isn't changing, they're just changing hands. So a transaction, whether it's a buy or a sell, it's always a net zero, okay? There's no additional shares coming into the market. So what we're really looking at what price is the transaction occurring? So is it occurring at the bid? Right? Which means that someone just waited and got their share. They were able to buy their shares on the bid, or um, you know, that's a sign of weakness if that's happening. So basically, someone could be bailing out and someone's selling to you, whereas transactions that occur on the offer, someone's buying your shares. So it's considered more bullish. Now, of course, like I said, if you're on the offer, someone may have sold your shares on the ask, but it's going to go through as a green item in the time and sales, because the fact that you forced a buyer to come and pay the top price on the offer rather than get filled on the bid by someone who wanted to sell. Um, so when we're reading the time and sales, when we're reading the tape, what I look for, especially when we come up to these critical levels, like the 350 level I'm just talking about, $3.50, it's a half-dollar level, it's important psychological level. I look for a stream of green sales going through. So green, 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 showing me that there are people buying off the offer, right? They don't want to sit and wait. They just want to jump in, and basically market orders that are taking place. Okay, those indicate to me that it's just a market order. People are so eager to get in that they're just placing market orders. They're not sitting around and waiting. Okay, um, so I'll just time and sales continued. So for me, when I'm watching the time and sales, I'm watching the size of the order, the price. You can have other columns for different pieces of information. You can watch which route the orders are being passed through. You can watch the time and the date and stuff like that. But for me, what's important is the size and the price. So the number of shares and the price. If I see an order go through for 30,000 shares, that's significant. Whether whatever side it's on, that's a large order. Wherever Whereas orders for 20 or 30 shares are not they're not really significant. So they're not going to move the price action very much. Okay. So this helps me when I'm looking at a stock that's about to break out, because I want to see people coming in with not just 100 share orders, but with 1,000, 10,000 shares. I want to see big buyers. I want to see people really, behaving in a really bullish manner. People coming into these stocks. Okay, this is where we go beyond just chart patterns, right? We have the chart patterns. They're telling us they're showing us the setups. They're telling us to expect a breakout at 350, but then we're actually watching the level two, and we're watching the volume coming in, but we're watching the level two to get confirmation that the breakout is probably going to happen after all. Okay, or maybe it won't. Just by watching how many people are sitting on either side of the bid or the ask, we can actually see, you know, is there a high likelihood of that breakout happening? Okay. Now, another note on the transaction is size. Okay, so we're looking at transaction sizes. When we see lots of 100 share blocks, these are oftentimes market makers just shifting shares. So a market maker, they make the market. The title is self-explanatory. But what essentially they do is they have to be on both sides of they're the guys that are distributing the shares one way or the other. They have to be on both sides of both the bid and the ask. Okay, so they're sitting on both sides. They're connecting the orders, if you will. They're the people. Think about them as they're the ones that are brokering the deals, if you will. So they're connecting the orders. So whenever you buy, there's someone on the other end selling, and that's what market makers do. Okay, they algorithms and institutional traders, they've got automated trading systems, and a lot of them trade in 100 share blocks. So when we see a stock with just 100 share blocks going through, I generally don't consider that to be particularly strong indicator of what retail traders are thinking, because I just sort of chalk it up to those 100 share blocks that are just algorithmic traders, you know, the HFTs that we've been talking about in previous lessons, the high frequency traders. Okay, they're just moving shares. It's not necessarily the actual retail traders like us. Now, it's the retail traders that are going to come in with big size. So I wouldn't want to get faked out into buying because I saw lots of small orders going through. I want to see the bigger orders because that's more indicative of a retail trader, you know, 800 shares, 1,000 shares, 1,500 or more, you know, bigger orders. Okay. Now, how do I place an order? So I place limit orders on everything. What's a limit order? Okay, but what do you mean, Tony? Okay, so I place a limit order, and that means I want to buy this stock, this many shares at this price, but for a max of X price. Okay, so whatever the current price is, that's where I'm going in, but I'm setting my limit. Okay, so let's say we've got a stock, and I had my order there at $3.52. So that was the limit order. It wasn't a market order. If the stock had spiked up to 360, for example, I wouldn't have got filled. I would have missed the fill. And you probably see me on my lives when I keep saying that, oh, I didn't get a fill. Or if you're watching the when the orders go in there, I'm only getting a partial fill or something like that. That's because I've got a limit order. It places a maximum level or a minimum level, depending on which way we're going, what I will prepare to transact at. So if the stock had spiked up to 360, I wouldn't have got filled. But as long as it was under 352, I'll get filled on my order. So it's considered a marketable limit order. Okay, anything under 352, when you hit that order, it's going to just be a market order. But if the stock pops up, you won't get filled. Now, for me, the advantage is that we sometimes trade stocks that are a little bit thinly traded. If we do a market order and it does spike up at 15, 20 cents, for example, uh, I won't get filled, but I'd rather not get filled than get a bad fill, right? Getting a bad fill, that's getting a bad price. It's going to throw off my risk reward ratio that I've used to justify getting into the trade in the first place. And for that reason alone, it's important to me to use limit orders. But it's really just not a good idea for me to just use a blank market order, right? I'm getting in a stock. Usually, I'm dialing it down to within a couple of pennies. So if I'm not going to get the price that I want in that range, I'm not going to want it anymore. Now, if you want to use market orders, some stocks where you can use them and you don't have to worry too much will be, stock like Bank of America, or you know MU, or Apple, or Microsoft, something like that. A stock that trades a ton of volume, because there's almost always going to be someone on the other side of the market to take your order without much slippage. Okay. Um, One of the risks when you're selling using a limited order is, say I want to sell the stock at, 349, but I have a limit that I'll sell as low as 340. Well, if the stock suddenly tanks to 325, my order's not going to get filled, but I'm going to be in a losing position. Okay. And I'm going to most likely just have to cancel the order and put out a new one to sell, even at an even lower price. And there are times where stocks will drop down very quickly and they'll rebound. So a lot of times when a stock does drop down quickly, I look to get out on the next pop, right? So the next time it pops up, I try to get out there. So even in those cases, I don't regret not using market orders. I usually think they're more harm than good in a lot of cases. Right. With my limit orders, as I was saying, I buy default go uh, 5 or 8 cents above the ask, and that's called an offset. So I'm offsetting the limit. Okay, I'm offsetting the limit order off the bid or off the ask, depending on which way I'm going. So if we're looking at a stock that has a spread of 350 on the bid and 355 on the ask, so looking at a 5 cent spread, and I'm a buyer, I'm going to put my limit order at 360. If I'm a seller, I'm going to put my limit order at 345. That'll give me a little bit of a cushion on either side. It allows a little bit of slippage, but not so much that it's going to throw off the reward ratio of the trade, right? You know, and the reason I do that is simply because I have to account for slippage. I'm willing to get into a trade at a slightly higher price if I really like the setup, but obviously not too much. You know, not to an unlimited extent. I mean, I'm okay paying an extra 5 cents or maybe a little more in some cases, but not an extra 20 or 30. So at a certain point, we just have to limit how much we're willing to pay. So in terms of uh, in terms of routing, one of the big advantages of working with CMEG or with uh, IBKR, utilizing Dash Trader, because I use Dash Trader Pro is my platform. One of the advantages that I've got with that is that I have direct market access, so that you can use Speed Trader, you can use Light Speed Trader, you can use uh, Sterling Trader, any of these direct market access platforms. This is one of the advantages that we have is routing. Okay, so we're able to route directly to the market makers. Now, with some of the larger firms, their routing is their proprietary system. So if you use interactive brokers, like I say, I've got accounts with interactive brokers, but I trade with Dash Trader. If I use the proprietary trading software that interactive brokers are going to try and push on me in most cases, most times. It's called Trader Workstation. If I try and use Trader Workstation, uh, it's their own routing system. So instead of routing directly to something like a market maker like Arca, you're gonna route they're gonna route their order through their own system, and they're going to try and pick up shares throughout their own system. Okay, and then route it out. Okay, so that results in a little bit of a lag time, or they may be routing it through their own third party and getting paid for that what's called payment for order flow. So they're getting paid to do it. So um, now, if it's got a bit of a lag time for a retail trader um, that trades a couple of times a month, that doesn't matter, right? If you're a swing trader or you trade every now and again, it's not a big deal. But if you're like me and like you want to be the retail traders, the day traders like you're studying here to become, then that's trading 10, 15, 20 times a day. I can't allow lag times. I need fast execution speeds. I can't allow a lag that's going to slow down my orders, especially with these quick ones I need instant fills. Okay, so direct access routing for me is really it's the only way that I feel I could trade. It's really critical for my strategy to be able to get quick fills. Okay, so anyone that's not using a broker that allows direct access routing, I think you're at a disadvantage. Depending on the speed at which you're trading or that you want to be trading at, you may notice it more or less, but it's something that I would look into. And there's a lot of brokers out there. There's many brokers that offer direct access routing. Um, like I say, if you look at the brokers that are partnering with DAS Trader or Sterling Trader, Speed Traders, you know, it's they will give you that direct market access via the software. Okay, now dark pools sounds nefarious, I know, but a little earlier in the course, uh, I mentioned dark pools. So, what are dark pools? Well, when we talk about the float of a stock, right? When I'm looking at picking stocks, and I go into the key data on, pull out the information from Benzinga, and I look at the key data on Benzinga. One of the things I look for is the float of a stock. Okay, and a stock that has, say, like Indonesian energy that we were trading today. Let's say it's got a 2 million share float. It's a low float stock. Okay, so when we go and place our orders, where all those 2 million shares, some of them are going to be available to retail traders like all of us, who we are, but some of them are going to be basically hanging about with institutional traders. They're going to have their own routes. Okay, so when we do routes, we're sending orders through the market makers, asking them to find shares. Now, dark pools are basically their pockets of liquidity. Um, they are pools or groups of shares that through standard routing, that are available to Joe Public, you and I, you wouldn't find. So it's really not fair, if I'm being completely honest. It sounds nefarious. It's not really nefarious, but it does sound nefarious. But it's to the advantage of the high frequency, the institutional traders, because if they want to go place a 10,000 share order and there's 10,000 shares in the dark pool, um, they get to hit that order and they don't have any slippage. Whereas, say, I want to do the same order, but I'm not going to a dark pool. I don't have access to dark pool routing. I'm going to get a lot of slippage if there aren't those 10,000 shares just sitting at 350, for example. Okay, so dark pools, it's an area where a lot of retail traders don't think it's fair. Okay, brokers, uh, some brokers have now offered routes that will ping dark pools. Not all brokers do. Okay, so the brokers that do offer that functionality, they'll go searching through the dark pools of liquidity to try and find shares. And the advantage for us, of course, is that if shares are found, we may be looking at the bid and ask and not see that 10,000 shares are sitting on the bid. But when we go hit the order of, uh, you know, doing the dark pool routing, uh, the market maker will find the shares for us and we'll be able to sell or buy whichever way we're going. The only disadvantage, I suppose, is that there's higher fees when you're doing dark pool routing. But in my opinion, if you're in a situation where you have such large size uh, that you want to get out without slippage, it's worth paying the extra fees, right? For me, it just makes sense. Okay, so again, not every broker has dark pool routing. Some, if you're with a broker, inquire with them whether that's something that you can avail of. Okay, it's something that you can. Some brokers will offer it, others won't. But if you're in thinly traded stocks, um, then you can get an advantage out of it. Okay, stocks that you might see, let's say 14.20 on the bid, and then one sale goes through and it's down to like 13.90. Okay, thinly traded stocks. All of a sudden, the next order is like 30 cents away. So that's a thinly traded stock. The level two is going to be very thin. So there's going to be a lot of spread between the bid and the ask. So in those cases, if you see, um, all of a sudden it pops up to say 14.20 uh, by 14.25, you may only see 100 shares at 14.20. And if you did an order with E-Trade, for example, just a regular non-dark pool routing order, you may get filled 100 shares at 14.20. And then the remaining 400, 500 share order, the remaining 400 of your 500 share order is at 13.95. So you get horrible slippage, right? On the other hand, you do a dark pool and you try to sell 1,000 shares, and sometimes you'll just fill the full 1,000 shares at 14.20 and you're out. You think, oh, great, what a relief, you know. So in general, I try to avoid trading stocks that are very thin traded stocks. So stocks that have very light. This is one of the reasons we look for high volume stocks, high volatility, stocks that have high relative volume. I don't like to one of the and again why we don't like to trade thinly traded stocks. Okay, so we're going to have those. I don't like lightly traded stocks with the kind of spreads that we're talking about here. But there are times where, even in the morning, when we have a lot of volume, a stock is a little bit choppy still, and those are the cases where using dark pool routing can potentially help you. Okay, maybe if you, particularly if you're looking to unwind a large position without a lot of slippage. So again, we want to harness the technology as much as we can to put more profit in our pockets. Okay, as traders, we know it's very hard. So people that have the disadvantages in trading are not generally going to be retail traders. So anywhere we can find a little bit of an advantage and a little bit of an edge, we really want to capitalize on it. So now that we're able to do dark pool routing, it gets us a little bit closer to being on the same level as institutional traders. And only a little bit closer, but every little bit helps. Now, if you can, prepare your orders in advance. And what I'd like to do in my montage window, the level two window I was showing you before, is prepare an order. So you can actually go in there, you can, if you got the order ready, then all you need to do is click the buy button or click the sell button. There's no additional confirmation window that pops up. So I can click the buy button, and my order's just gone. It's going to be live. Okay, so for me, I like doing that because generally I have my orders prepared, a little bit ahead of time. In a lot of cases, if I see we're approaching a breakout level, I'll have my order placed ready there, and I can either set the order as a stop buy order and it gets filled, or I can prepare it and all I need to do is click the buy. The only exception would be something like when say after hours, there's a stock that's just spiked on news. And in those cases, I might not have enough time to really prepare the order, so I might just have to go in with a live hotkey or hot button that's just going to market me in. Okay, but in general, I prepare my orders in advance. So in the morning, if you're looking at that 9 a.m. to 9:25. You're looking at you're preparing the orders on the montage window for the stock that you're watching, the stock that you've got in the montage. Okay, so what the big gapper is, the momentum stock that you're looking at, the critical levels of resistance, and you prepare an order right around those levels, and then all you have to do is make them a live order, is click send. If you've got multiple level two order windows open, so you might have two, three, four level two order. Typically can have two or more level two order windows open at any one time, and then basically you can have multiple orders ready to go. All you have to do is click send. Okay, so preparing orders for me, it's just very quick. It's very easy. Then then you can just hang out there until you're ready to send it, and then click send. It's easy, and you can prepare those orders with hotkeys. I'll go over hotkeys, or you can go use hot buttons. And I'll go over both hotkeys and hot buttons in a few minutes. Okay. Now, cancelling orders. So equally, maybe if not more importantly, being able to quickly cancel an order. So, say you accidentally placed two orders instead of one, or you placed a limit order to buy something at 350 and it spiked up to 360. Well, you don't want to get filled if it drops back down. You know, just because someone's selling because they made money, you just want to cancel it. Okay, so having a button where you can cancel your orders is important. So for me, I've got the escape button, the shift escape and it cancels all orders. Okay. Um, the open orders, I can get Control Q, and that allows me to be cancel last order, and it allows me to be very fluid, very quickly adapt to a change in the market where I might decide, I don't actually want to be buying this anymore. I'm just going to cancel it. Okay. So I can go over, I'll go over and show you uh, the level two in a second. I've got a little video which will show you where orders are getting placed and on the level two and how to cancel, etc. Okay. So now, where's this one? When I'm scaling out of trades, as many of you that watch me now, and there's quite a lot of you that have watched me, that uh, when I'm scaling out of trades, as part of my trade management, I'm selling into the profit. So when we have a stock that's moved up and I'm in the driver's seat on it, I'm going to start scaling out. And when I do that, I try to sell on the ask. Okay. By selling on the ask, by putting my shares on the ask, I'm forcing someone to buy them from me. Okay. In a strong market, we'll just force people to buy our shares. Okay. Now, in a weak market, we might not have that option. So we'll just have to bail out. We'll just be selling to someone that wants to buy on the bid. And it it may be a market maker, right? We'll be bailing out to whoever will just take our shares. But selling on the offer, it forces the buyers to come to you. It increases the momentum on the time and sales when you're getting filled. It's going to be, even though you're selling, it's still going to be green orders because it's someone buying shares on the offer. Okay, so when we go and hit a market order just to bail out of 5,000 shares, and it's on the bid, anyone that sees that on the time and sales is going to think, oh, someone's starting to unload. And I never want to encourage weakness. And a strong momentum stock, I want to keep that strength going. Okay, so I want to keep it going as long as possible. So I try to sell on the offer. So if I sell on the offer, I'm not encouraging other people to paper hands, if you will, and maybe think about just bailing out with a market order. So a market order that can cause a stock to very quickly drop down. Okay. Now, my sell orders I prepare like the same way, like the buy orders, and it's exactly the same thing. And I do have the hotkeys, so I can uh, for sell orders, so I can very quickly throw an order up to bail out, and I don't have to prepare it. I can just press the button, and it's a live order. Okay, if orders aren't filled quickly, I'm I'm gonna cancel them. Okay, and then just place a new sell order. So you know you might you might have seen me put a sell order on a stock. Let's say I put a sell order on a stock at 354. Okay, and it gets filled, and I put one at 355 and it doesn't get filled. Okay. Um, that means it was a little heavy on 355. There are a lot of people sitting there trying to sell. And I tried to join them, can't get filled. So I'm just going to cancel and cancel that order and bail out. And you know, the rest of my position, maybe sometimes that's just what you've got to do. But having the hotkeys and the cancel keys makes it very quick to get in and out of trades. No, again, the type of order that you want to do, and this is the script that you put into your hotkeys allows you to do this. Okay, so some traders like to hide their shares. So if you're using Arca, for example, as your root, you can choose to display 10% of your actual size. So if you have 100,000 shares that you're trying to sell, and I, I don't think many of you to start off will be trading at 100,000 shares, but let's say you want to, for the purpose of argument, you've got 100,000 shares that you're trying to sell. You could just show 10,000. Okay, so if you're trading a thinly traded stock, it might be better to hide some of your shares and not scare away buyers that someone's trying to bail out of 100,000 shares. That's it's just going. It's one of those things where if what people are watching the level two, they like to be able to not show all the cards. So some traders do that a lot. Actually, I personally don't do it a lot, but to be honest, I'm not trading I'm not doing 100,000 shares. I'm not doing 50,000 shares. So I don't think I'm trading the kind of size where I think my shares are actually going to be noticed. So it's not as if it's causing an issue. It's not something, if you're not trading the big size, it's not something that you really need to do. Okay. But in some of the low float, thinly traded names, it might work to your advantage. But it's kind of part of the game of level two, where you see people buying up shares on the offer, and they're buying up 10,000. They're buying up a 10,000 share seller. Then all of a sudden, the 10,000 share goes away and it turns into another 10,000. And so you realize that, okay, I guess there's someone trying to unload more than just 10,000. There's someone hiding shares there. There's a hidden seller. Some people talk about hidden sellers or hidden buyers, and that's what we're talking about. Okay. Now, in terms of buyers for the most part, if they're bullish, they're not going to hide. They're going to show themselves as being there. If they're trying to cover a short position, they may hide. Okay, but what what we definitely notice, there's level two. There's definitely some manipulation. There's some games of manipulation on the level two. I don't think anybody can dispute that. So just be wary of that. People put orders up, false orders. I could put an order up for 30,000 shares of a stock on the bid and then just cancel it. Okay, so people do that and they'll put up fake orders, and then they'll just cancel them. There's a certain level where there's a certain point where watching the level two by itself can drive you crazy, because you'll see what you think are patterns, or you think are buyers lining up or sellers lining up, but that may or may not be true. So what I do, instead of just looking at any stock and studying the level two, I instead look for the chart patterns. Going back to the previous lessons, we look for the chart patterns first. We look for the setups first, and then I like to look for the strong stocks, and then after that, I'll look at the level two, and only then do I look for level two. I'm looking for basically what I'm looking for is confirmation. Okay, I'm looking for those levels of resistance and support, something that's conforming to what I see on the chart already. That way, I feel that's the way it works best for me. If I find when we're trading the heavy volume stocks that the orders we see, especially in the morning, they're more likely to be real than to be fake. Okay, if we're trading the really low volume, you know, early afternoon, low liquidity market kind of, then we're probably going to get caught more in that manipulation. And realistically, We know that's not the best time of day to trade anyway. Okay, trading low volume stocks is usually just asking for trouble. So it's something we should probably avoid anyways. Okay, now adding and removing liquidity. This again gets into some of the more nitty gritty details of trading and level two. Okay, depending on your broker. Now, I get this. I get this with my broker. Depending on your broker, um, I use CMEG or Interactive, but E-Trade and Ameritrade, I don't believe you get it. But with a lot of the direct access brokers, actually they'll pay you a small commission for adding liquidity, and they'll charge you a small commission for removing liquidity. So it's important to understand the difference between adding and removing liquidity. Okay, so when you remove, well, I'll start with removing liquidity. When you remove liquidity from the market, you're doing a market order. Okay, you anytime you do a market order and you get filled like instantly, you're taking from the market. You're taking shares from the market. Whether it's a buyer and you sold, you bailed out and someone bought, and or you're a buyer and you just jumped in and took what was on offer. Either way, you're you're taking anytime you take a market order, it means you're taking liquidity out. Okay, you're removing liquidity, so you'll get charged for that. You get charged to remove liquidity. Okay, now when you're adding liquidity, what you're doing is you're adding shares to the market. I mean, you're not, figuratively speaking, you're not actually adding shares to the market. It's still a zero sum market, but what you're doing is you're putting more shares, making more shares available to the market. So that's going to be any order that's not marketable right now. Okay. So if an order is not marketable, let's say you want to buy 2,000 shares of a stock and the spread is 345 by 350. If you put your order at 345, you're going to have to sit there and wait. By putting a buy order at 345, you're adding liquidity to the market. Okay, you're adding those shares that that you want to buy to the market. If someone comes and markets out and bails out and you get filled right away, well, that person is going to get charged for removing the liquidity, right? But you're going to get credit for adding liquidity. So by adding and removing can be a little bit confusing. One of the reasons that I try to sell on the ask a lot is um, not only to get the best price, but when I sell on the ask, and I have to sit there and wait for someone to come and buy my shares. So I'm adding liquidity to the market. I'm all right. That gives me a little bit of a discount on my commissions. They're called ECN rebates or EC, or it'll if I can do that. And I get a little bit of kickback if I'm adding liquidity. But conversely, I get charged for removing it. Okay. Now, sometimes adding liquidity and uh, taking liquidity can get taking liquidity away can get confusing. But just remember, if you're being charged those ECM fees, they can add up. Just like commissions, regular commissions. So your broker will add your regular commissions, but the ECM fees. And what I've found is if you're looking at market orders, um, the the ECM fees can add up to be even more because If you've got a broker that's charging per transaction, for example, um, that is a good way of if you and you're buying reasonable sized share size, it's going to limit your exposure to commission fees. But if you're taking away liquidity, um, then those ECN fees and they're charged based on the share size that you take. It's the number of shares. Okay, so that's another thing that you really need to be uh, conscious of. Okay, so it's something I watch and I try to uh, sell buy on the bid and sell on the ask if I possibly can. But that's only it's only going to happen if you've got a high volatile stock, a highly volatile stock where it's it's up and down. If it's just going without you, then you have to cancel the order and go it again. So that's something that you've got to be uh, you've got to be conscious of. Okay. Now, adding liquidity, adding liquidity. Um, if you're adding liquidity to the market, you're actually improving the market conditions. Okay. So what that means is that you're making shares available to the market that weren't there already. So if you're if you're looking to if you're putting an order out there to sell your shares that you already have, and it's not something that can be filled right away, and you're asking the market to come to you or waiting for the market to come to you, that's considered as adding liquidity. Okay, and that's where you will get the rebates. Now I'm thinking in general, if I you know, we're looking for as retail traders, we're looking for patterns that are going to cause breakouts. Okay, and that's where it's good to add liquidity, so we can actually place orders, set orders in there, and get them into the level two at those areas where there are breakouts, because we know that the volume's going to come in. Okay, and you know that way we're more likely to get filled on that order as well, and we're adding the liquidity rather than removing it. So adding liquidity to the market, you're improving the market by adding those shares, like I say. Okay, and any order that adds liquidity, if you've got a direct market access broker, um, then if we take Arca for example as a market maker, they're going to pay half a penny, you know, half a penny for uh, every time that you add that, and that's half a penny per share. So it can mount up. Okay, so they're going to pay half a penny per share. So if you've got 10,000 share order, and you add liquidity for the whole thing, you can make $50 on just for adding liquidity. On the flip side, if you bail out and you remove liquidity, that 10,000 that 10,000 share order is going to charge you $50. So that's an extra charge that you might get charged. Okay, so that adds on to your commissions, and that's why my expenses certainly last year um, were a lot more than just the commissions alone. Now, some brokers have routes where you don't get charged ECN fees, and so they have free routes, and some brokers have, and you can use those free routes for most of your orders, unless you specifically want to route to a different market maker, for one reason or another. Let's say you don't want to do, let's say you want to do dark pool route, and then obviously you want to go through a market maker that has access to that. So that kind of thing. Okay. In general, there'll be a small fee for removing liquidity, uh, and a small rebate for adding liquidity. Okay. Now, um, we've got a okay. So here we can watch. I'm going to go ahead and press play on this one, and this stock. So this stock is called VHC. So on this one, you see the buy order being clicked at 460. So we can see they get the offer here at 460, and then all of a sudden it starts to move and it pops up. Get that quick pop up. Okay. Now in this case, we popped up there, kind of hesitated at the level, and I don't usually like seeing that kind of hesitation, but we did, and we get that little bit of a pullback. So at this point, I usually have about a 10-cent stop, right? So about 10 cents. Now this one, I remember this. You're getting 460. You're looking to double at 470. That's the kind of adding to the position. And at this point, you're just watching the level two, and then you see someone just came in with 6,000 shares at 456 on the bid. Okay, so that person came in and immediately we got a little surge. Okay, okay. Now you want to see this here. It's going up, and that's a stock. So what we're seeing here is that we get a lot of volume, and it can move very quickly. What's wrong with this? What's wrong with this video here? Okay. So what we're getting here is that we can see that it's coming, and you see the activity here that we're getting. It's the buy in there at 460, and then we get the surge, and you can see the top level there, the level two. You see the orders, what we're actually seeing there down at the bottom, the bottom one. Um, so you can see that the next level we're getting a bit of a pullback, and then we're looking to add to the position. So we're looking to add at 470. So we're just waiting for that pop and that surge on the level two. And then, this is normal. Okay. And it's coming up there right over the buy button. And we're getting, we see a little bit of resistance at 465. And I know it's confusing because there's two level twos in this video, but there's a little bit of resistance, and then we pop over that. Okay, so we just look to find a little bit of resistance, and then we can see it's 12:05 now. So just want to see where the orders are going, and you can see there that just pause that there. And so watching this, it's come here now. This trade, I'm now in the profit because my average is 460, right? So now I'm sitting in the profit zone. Okay. just hanging out with basically my hand on the trigger. And I mean, one hand, I'm wanting to double up and add more size at 470. But on the other hand, if this thing pulls back, I want to be able to get out quickly rather than take the loss. Okay. So that's a surge of volume that started to come in, and they're 68, 69. Then now we need 20,000 shares. So you see that order at 70. It's a little bit of an issue. Um, so it went from being, up 8 cents to down 2 cents on the trade. So this is a point where, in a lot of cases, I would decide to bail out, typically flat. Okay. So level of 470 was tested and was able to break. I really wanted to see those levels break down again. But trading at lunchtime, it gets very choppy. So you have to expect if you're trading midday that your stop is going to be tested before you make money on the trade. I mean, it's almost inevitable with midday trades. Expect to be at a loss before it comes. Be fully prepared to take a loss midday. Okay, in the morning we often get such clean, quick resolutions that we don't have to experience the emotional frustration of being in a losing position because stocks just right out the gates will start running. Okay, um, but couple, we're up a couple of cents. Um, at this point, I mean, it's hardly it's just a flat trade. But now, look, a bid just came in there at 63. It looks like 13,000 share bid. Someone just came in there at 465. So now I've adjusted the level two, so it's on a bigger window. Now there's 9,000 shares sitting at 463. So someone is sitting there propping this up a little bit. So we don't know if this is a real order or if someone's just trying to prop it up. But in either case, someone's sitting there with a 9,000 share order at 363. So there's someone else now with a 5,000 share order. So I want to see this come up to 475 and break it. So I've got an order ready for 500 shares to add a little bit more, and I would be ready to bail out if I saw 463 break. I'd be thinking about bailing out of 463 if 463 breaks. I want to see that level hold. If they sell it off, then I'm going to be a little bit nervous. The huge ask is not bad if it gets bought up, but look at that. See how quickly it went from 463 and dropped down? We can anticipate that kind of thing because we have someone sitting there holding it up, and then all of a sudden it's gone. Okay. So that's the same thing on the offer. When we see someone sitting there holding it down at 470, when it comes up there and breaks, a lot of time it's going to be very, very quick break. So my stop on this one is 449. You can see that I've stopped out at 463, but then all of a sudden, look at that. Look at that surge of buying. All of a sudden, it just popped up there for a second. I would consider taking this at break even just because it popped back up, and I'd say, you know what, maybe I'm just looking to get out of this thing because this is a stock that can run, and I'm still holding on to it here on this trade. So 467 now. It's not uncommon. Also, it's not uncommon for stock like this to come back up and break through the level, and all of a sudden anyone that was long and got stopped out could be so frustrating when you get back in and twice in the position size, and then we do a break of 470. Gets a quick squeeze. So just because it comes down doesn't mean when it comes back up a second time it won't go right. Here on so we're getting a lot of green. We've seen a lot of green. All of a sudden, it just went from being down $250 to back in the green, and we're thinking, all right, here's 469 in the offer, and we're going to see if it breaks. 10,000 shares at 470. We've still got 10,000 shares. Seller at 470. So look here, we've got buyers. Okay, so I'm watching this. Add a little bit 470. out of that 500 shares, we get a pop. That's the quick pop that we're looking for. So when we see something like that, I'm usually going to think, okay, that's the resolution. That's the big surge of buying that we wanted. That's anyone that decided to short it down at 455 when it was coming down, possibly covered at the highs. Okay. Now, this point, when we're hovering right around the level of 470, I usually like to see a bigger cushion, a bigger move off that resistance level than just, breaking over by 3 cents. But again, this is typical midday trading. It's easier trading in the morning, so it can be very, very slow. I mean, we're only up 10 cents right now, but it's been interesting to say the least. So you know we sort of have that pause and then buying, and that by itself would make me a little bit nervous. Um, I'd probably have to bail on this if I had bought it if I bought it at 470. 470 for the break, and then all we got was this 2 cent pop. I probably think pretty quick. I'd think just to bail out. Okay, a little bit of selling there. Okay, a little bit more selling. And I'd probably be thinking might be time to get out. So you see that little push, that push of selling that goes through on the time and sales. Well, now we're watching this level two right now, independent of the chart. So you basically just seeing me watch the resistance at so at the charts. Okay. Now, this is an example of studying level two, and you can see how it can move around. But the critical level of resistance was 470. We broke above it and then came back in. That for me is definitely a problem. The odds of it now going back up to 375, 380, every time it fakes out like this, the odds just become slimmer. But with that said, midday trading can be very choppy. You can have large buyers and sellers moving in and out, all the time, and it causes big ripples every time. So this trade continues to play out. Don't remember how long the video of this trade actually is. I think that's pretty much it. Okay. Okay. So that was level two. Um, that was the level two. So we've got another example here, which is also quite interesting, which is I think this was an IPO. Um, if I'm just let me just yeah, I think this was an IPO stock. Yeah, it was an IPO stock. Okay, so now what I want to do here is again I want to so we're in this thing. It opens up like 19. It's already 21, 22. I mean, look at how quickly this moves on the level two. Okay. So when we're trading IPOs, you have to be prepared for potentially massive slippage. I mean, just think about how quickly this is moving. And if you hesitate placing your order, or if your order has to, ask for confirmation, something like that, if any of those types of things can really slow you down, you don't want to be slowed down. When a stock is moving like this, um, so look at this now. We're back down at the lows of 1980. So I've traded IPOs a few times where I took 200 shares and pulled back 3 points. So I was down $600 on 200 shares, added 1,000 on the pullback, and was able to make a profit out of it. But um, you have to be prepared to potentially be at big losses when you trade IPOs. Really, trading breaking news is no different. this is an IPO, but it could just as easily be breaking news or earnings that just came out, So you have this huge amount of volatility, this tremendous amount of volume that's flowing into this name, and the market is just trying to line up all the buyers and all the sellers the best it can. But inevitably, you have slippage, you have big spreads, and these types of trades can be very, very risky. So again, with trading IPOs, trading news, it can be a sub strategy of the momentum trading strategy, the momentum trading strategy that we look for, that we look for stocks that are moving up quickly. What I was looking at on this one was okay, it surged up to 2187. I was going to watch it over, let's say, 22 for a little bit for a breakout, something like that. Basically, looking to buy the first pullback and that kind of thing, and that's the type of trade I might take. But we just have to remember that when we're trading an IPO, it's going to be pretty risky. Okay. Okay. So let's talk about hotkeys. Just go over the hotkeys uh, quickly. And for me, the hotkeys, they allow me to be very, very quick with my trades. I couldn't trade without them. I use hotkeys. I use a combination of hotkeys and hot buttons, and I find that is best. That's my strategy, and I find that the best for me. Okay, I couldn't trade without them. It's part of my strategy, and my strategy requires being quick. So if I didn't have the hotkeys or hot buttons, it would be really difficult for me to have to get in there. Okay. Now there are two types of hotkeys. I have the hot buttons, but there are also two types of hotkeys that I use. Okay. Um, and the two types of hotkeys are one to prepare orders. So one type that just prepares the orders. And then I have hotkeys that'll actually send live orders instantly, right? So the hot buttons that I use are a form of the latter. So they send live orders. As I click that, it's a live order goes direct out. Okay. So whether you're using a direct access software, or Dash Trader, or you're using Sterling Trader, or you're using Lightspeed. Hotkeys are available with a lot of brokers, okay, and you just have to look into how to set them up. Now, how to use them properly. Now, this is um, Dash Trader or direct access software. Um, Now, this, for instance, is how I set a lot of my orders up. Now, this is going to be a hotkey buying order. So here we've got 3,000. Uh, okay, so just click the next one. So here we've got 3,000 shares, and I'm routing it through JPCC, which is a market maker. Okay, and the L that's on the end of that stands for limit. Okay. Now, it's JPCC. That's the name of the route. That's the name of the market order. The L is the limit. The share size equals 3,000. The you can how many shares you can see how many shares you want to show. So if you've got 3,000 shares is what we're looking to buy, but the tog share, okay, that's how many shares you want to show. Remember, I was saying that you can actually hide shares. So if you want to hide your shares, you put how many you actually want to show in the tog share. Okay. So I don't want to hide my shares in this particular setup, this particular order. So I'm just going to show what I have. Okay. Then I'm going to look at what's the price. I'm going to say the ask plus 8 cents. So I'm going to give it a 8 cent slippage, potential 8 cent slippage, but I don't want to give it too much slippage. Um, what does that mean? It, the RR means the no RR means no reroute. Okay, so I've got that set to N, which basically means that I don't mind it being rerouted to other market makers. If you set that to Y, it means that you don't want it. You don't want to have your orders rerouted. Okay, so first, it's if it sends it to Arca and Arca doesn't have the shares, it's going to reroute it to Nasdaq or JPCC or whatever. You can choose to say don't reroute my orders, and then there are certain instances where you would want to do that, but typically, for my typical orders, I'm going to say go ahead and reroute it. Just get me my shares. Okay, it's a buy order and the time in force is the day, so the regular session. So when I hit shift 3, so here when I hit the key, which is shift 3, then this order is live. It's going to send out 3,000 shares uh, at the buy at the it's going to send out 3,000 shares at the ask with a potential slippage of no more than 8 cents, and it's going to be live. Okay, so just hit shift 3. I'm going to have 3,000 shares. Okay, so whenever I press shift 3, it's going to buy 3,000 shares. So be careful, because if you've set up your hotkeys in a way that your keyboard, if you've got a cat or something that walks across your keyboard, you don't want them buying shares for you. Okay, or if you drop your drink on your keyboard or something, anytime those two buttons are pressed, live orders are going out. So just be a little bit careful. Okay. Um, Make sure to either close your keyboard, switch off your keyboard, close your laptop, or whatever it is when you're not at your desk. Okay. But whatever you do, whenever you need to make a move quickly, the keys are ready to go. That's what the hotkeys are for. So I've got these set up for 3, 4, 5, 6,000, in increments of thousands, 1,000 shares at a time, and I've got them set up higher and lower as well. So I've got them set up for 1,000 all the way up on the shift. I've got them set for 100 all the way up using my control as well. So I can get in there fairly quickly. My hot buttons, I'll show you my hot buttons in just a moment, but I've got them set up a little bit different. So I've got them up to I think 25,000 at the top, um, at the top end. And down here I've got the cancel all orders, which is control Q. So basically any orders that are pending, I press control Q and it cancels them. Okay, so just a quick way of cancelling any orders. If I'm getting, let's say if I'm getting a partial fill, or I tried to buy 3,000 shares, and I've got 2,200 filled, my order's just sitting there. Maybe I'll cancel it. Maybe I'll just take what I got and cancel the rest. Okay. Now, so hotkey selling orders. Um, these I would say these in a lot of ways are even more important for getting out of trades. When you have profit, it's important to get out to get out of trades with profit. So I like to sell half and quarter position sizes. So if we're looking at sell half your position, sell quarter of your position, sell all of your position. Okay, so it's just bailout. So Control C is quarter position control. So you can actually sell some of your system. So here I say the share size equals to the position times zero point 0.5. Okay, or position times 0.25. Computer does the maths for me, right? That's the let the technology do the maths. Let the computer do the work for you. It's good at maths, better at maths than a lot of us. Um, so it'll do it for me. Whether I have a partial fill of 280 shares, um, or I've got an even 1,000 shares, it'll do the maths for me. So I don't have to worry about it. It's just in these orders, it's just going to sell a quarter of my position that I'm holding, or it's going to sell half the position I'm holding. But look, it's going to sell it 10 cents below the 10 cents below the bid will be my limit order. Okay, so it's going to basically go as a market order, would be removing liquidity, but it'll get me out of the trade. Okay, I'll let it reroute. I'm not going to worry about it. I'm going to let it reroute, and so I'm not bothered where it goes. I just want it to get my I just want to get my shares sold, and then the time in force is the day. Okay, so I've got that to sell. I've got to sell the quarter, sell a half, and sell full amount. Okay. Then on the flip side, when I want to add liquidity, excuse me, when I want to sell on the ask, okay, I'm going to say, let's route this through um, Arca. Excuse me. So I'm going to say, let's route this through Arca, which I know gives higher ECN rebates. Um, the the broker let me know that that's the case. So they have the highest rebates, or and they also charge the highest commissions as well. So you can get rebates from that. So that's what I tend to route it via Arca if possible. So if I'm going to add liquidity, I want the best rebates. Okay, that may change from time to time, but at the moment Arca is going to give about I can sell this the full position. I can sell half the position. Or again, I can sell a quarter of the position. Okay, so that allows us just to toggle the share size. I'm not going to worry about the price, what the price is, you know, on the ask. So there's no reroute, and just yeah, okay. So I'm selling on the ask, not rerouting it, and the time in force is the day. Okay, so that's when I'm trying to add liquidity, because I want to try and get some money back. But if they have to reroute your orders through another, you still might get charged ECN charges. If they have to reroute your orders to a different market maker, then you still might get hit by the same fee. So if they route it through NASDAQ, for example, or JPCC, um, it's just a way of getting reducing your commission, the overall commissions. If you don't want to reroute um, here because you want it through Arca to get the commissions back, you put no reroute to Y, okay, and that way you get some ECN fees. Okay, time in force is the day, as I say, and cancel all, Control Q. Okay, now when I'm actually up on my on my montage, If I have my montage here, for example, setting up my montage. If so what we're doing here is when you're on your montage, if you right click on your montage uh, on this, it pops up and it says layout config. And then you can add hotkeys. If you want to set up hot buttons, it says add hotkeys into the box. So you click here where it says right click to add a hot button. Okay. So then it displays this one. You get the hot button and you add it to the style there, and then you click OK. And then when you actually come back to the montage, you then just right click here to actually add your button. So you can actually add the hotkey buttons. Then you can rename your hotkeys and whatever the name of the hotkeys actually is. And then you uh, add your script from the hotkey script into the hot button. So I'll show you a little bit more about what's actually happening there, and I can help you with that. Like I say, this is Dash Trader. It's slightly different for Sterling, for Lightspeed. If you've got a direct access, most hotkey buttons will do it, but I'm showing you for Dash Trader. Okay, so this is typically what my montage looks like on any given day. So we've got these are my buttons. So I can buy 1,000 shares here on this, and it will buy 1,000 shares with a 50-cent stop loss. 500 shares with 50-cent stop loss. I can buy 90% of my buying power with a $1 stop loss. Okay, and then if that goes in there, I can then move that stop loss accordingly. That's a good way to actually set a position with a stop loss. This it's all limit orders, and I've got it's as soon as I click this, it sends a live order to the market. So buy basically I'm buying at a market order with these buttons. Buy 90% of your buying power. So if I just want to get in on a quick surge at the market open, I can buy 50% of my buying power, and then when I want to add to it, 90% of my buying power, and it takes me up to that 90%. Again, if I want to just half the position in the montage for setting up the orders, and then just click the market for buy and sell, I can do that. I can click the cancel button for canceling any orders and stuff like that. So I've got all of this set up on the montage, and this is what I use to get in and out of the market very, 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 very quickly. Okay, now I know that's a lot to take in. I know it's a lot to understand. What I would again play around with it, study it, try and understand it. A lot of people get confused with the level 2. It's not essential. A lot of traders trade without the level 2, but I use it very much for confirmation. So if I'm you look at you get your good stock selection first. Chart patterns is the next piece in terms of the setups, and then you look at level 2 for the confirmation. When you get looking for the volume for the breakouts of those flags and those setups, you're looking for the level 2 to confirm that there is potential for that to happen. Are there big orders to do that? So any questions, if there's something that you're not unsure about and you've got more questions, just drop me a line, Tony at hustlewithtony.com. And if you want to just try charting, Benzinga, TraderView, you should be familiar with these tools now. And when you get the PDF, if you want to download the PDF of this presentation, these links should be clickable. So don't worry about that. Drop me an email, and the next one is more about running your business, your day trading business. If you're going to be a full-time professional day trader, you want to treat it as a business. So I'm going to go over some key points of running a day trading business. So join me for the next lesson, and I'll see you there. So thanks for joining me for this one, and goodbye, and enjoy your trading.